Wall Street analysts just raised price targets on three dividend paying energy stocks, signaling a potential $142 gain on core energy alone by 2026. The surge in oil prices from US Iran tensions is shaking markets but boosting energy firms' cash flow, which means bigger dividends for your portfolio. UBS analyst Josh Silverstein upgraded Chord Energy's price target to $142, citing its strong position in the Williston Basin and rising cash flow in 2026. RBC Capital's Scott Hanold also raised Permian Resources' target to $20, expecting a 4% production increase and strong financials to support dividends next year. Here's where it gets interesting. These dividend hikes could add hundreds to your yearly income, but timing your buy before March 2026 is critical. EOG Resources, a major U.S. oil producer, just got a bullish upgrade from top analysts expecting a 12% production increase in 2026, boosting your potential dividends. Analyst confidence in EOG Resources is driven by their strong balance sheet and $2 billion capital budget, aiming to maximize free cash flow for shareholder payouts. Here's where it gets interesting. Rising oil prices combined with efficient operations mean EOG could increase dividends by up to 20% in 2026, directly padding your retirement fund. Permian Resources, another top pick, is expected to hit the upper half of its 186 to 192,000 barrels per day target, strengthening your stock's cash flow potential. Scott Hanold from RBC Capital raised Permian's price target to $20, reflecting optimistic 2026 forecasts that could add nearly $1,000 annually to your dividend income if you hold shares. Permian Resources plans to boost oil production by 4% in 2026, aiming for the upper half of its 186 to 192,000 barrels per day range. RBC Capital's Scott Hanold expects Permian's capital expenditure to stay near $1.85 billion, supporting steady growth in dividend payments through 2026. EOG Resources is also increasing its dividend, reflecting strong cash flow from higher oil prices and efficient capital management in 2026. Higher dividends mean more cash in your pocket, but rising oil prices also increase production costs, which could squeeze profits if prices fall suddenly. Tip ranks analysts like Josh Silverstein and Scott Hanold by success rate and returns, helping you identify reliable stock picks for your portfolio. RBC Capital's Scott Hanold highlights Permian Resources' strategic focus on cost efficiency, aiming to keep production costs under $30 per barrel through 2026. This cost control means your investment in Permian Resources is better protected against oil price drops, shielding your dividends and potential stock gains. UBS analyst Josh Silverstein also points out Chord Energy's plan to increase share buybacks in 2026, potentially returning nearly $300 million directly to shareholders. These buybacks can boost your stock's value by reducing shares outstanding, making each share more valuable and increasing your potential returns. Watch for the upcoming quarterly earnings reports in April and July 2026. These will reveal if these companies can sustain their dividend growth and buyback plans. Tip ranks analyst Josh Silverstein at number 419 out of 12,100 with a 66% success rate and average returns of nearly 12%, boosting your confidence in his picks. RBC Capitals. Scott Hanold expects Permian Resources to increase oil production by 4% in 2026, pushing output toward the upper half of their 186 to 192,000 barrels per day target. Here's where it gets interesting. Permian Resources plans to spend up to $1.95 billion on capital expenditures this year, signaling aggressive growth that could lift your investment's value. EOG Resources is not just raising dividends, they're also focusing on cost control, which means more efficient operations and potentially higher returns for your portfolio in 2026. Wall Street's bullish stance on these three dividend-paying energy stocks signals a shift that could impact your retirement savings, especially if you hold energy sector investments. Permian Resources is accelerating its focus on sustainable energy projects, aiming to reduce carbon emissions by 15% by the end of 2026, impacting your investment's future value. EOG Resources is investing $500 million into advanced carbon capture technology this year, which could enhance its profitability and protect your dividends against regulatory risks. Chord Energy's new drilling techniques have cut production costs by 10%, potentially increasing free cash flow by nearly $100 million annually, directly boosting your returns. But here is the catch. Rising geopolitical tensions could disrupt supply chains, causing volatility that might slash your portfolio's value by up to 8% in the next quarter. And next week, we'll reveal the top three energy stocks with the highest dividend growth potential for 2027, the ones that could add an extra $1,200 to your yearly income. If this saved you even one bad financial decision, hit subscribe. Your future self will thank you. Drop a comment. What's your biggest money worry right now?